How do I report a 401k rollover on my tax return? Have you recently rolled over your 401k and are now wondering how to report it on your tax return? Let's break it down in a straightforward way. The way you report your rollover depends on whether it was a direct rollover or an indirect rollover. A direct rollover is when your 401k funds are moved straight from your old plan to a new qualified retirement account, like another 401k or an individual retirement account. In this case, you typically do not need to report this as taxable income on your tax return. You will receive a Form 1099-R from your plan administrator showing the distribution. Since the funds moved directly, this rollover is not taxable, and you usually do not have to do any special reporting beyond keeping that from your records. Now, let's talk about an indirect rollover. This happens when you receive the distribution yourself and then deposit those funds into a new retirement account within 60 days. In this situation, you must report the distribution amount from your Form 1099-R on your tax return. To show that these funds were rolled over and not taken as taxable income, you write rollover next to the line on your Form 1040 where you report the distribution. If any taxes were withheld from your distribution, you also need to report that amount on your tax return. It is very important to redeposit the full amount within 60 days. If you do not, the portion that is not rolled over will be considered taxable income. Additionally, if you are under the age of 59 and a half, you might face a 10% early withdrawal penalty on that amount. Here are some key points to keep in mind when reporting a 401k rollover. Always keep the Form 1099-R you receive, as the Internal Revenue Service will expect to see this form with your tax return. For direct rollovers, the reporting is minimal because the transaction is not taxable. For indirect rollovers, make sure to report the distribution and indicate that it was a rollover to avoid taxes. If you converted pre-tax 401k funds to a Roth individual retirement account, that is a taxable event and must be reported as income. Certain distributions, such as required minimum distributions or hardship withdrawals, cannot be rolled over and are taxable in the year you receive them. From a retirement planning perspective, choosing a direct rollover is often the best route to avoid tax complications and potential penalties. Properly reporting your rollover helps ensure your retirement savings continue to grow without unexpected tax liabilities. If you have any uncertainty about how to report your rollover or the tax consequences, consulting a tax professional is a wise choice to align your reporting with your retirement financial strategy.